If you're a high-income W-2 earner who wants exposure to real estate without managing tenants, toilets, or renovations, private money lending might just be one of the most underrated strategies out there. It's personally one of my favorite ways to invest in real estate right now, especially because it fits my lifestyle, my travel schedule, and my corporate job. Today I'm going to break down what private money lending is, the pros and cons, and I'll walk you through a real deal I just funded using my retirement funds. So what is private money lending? At its core, private money lending is when you act as the bank. Instead of putting your money into the stock market or a traditional savings account, you're lending capital to a real estate investor for a specific project. It's usually something like a fix and flip, a short-term rental conversion, or another value-add real estate project. Your loan is backed by real estate, secured by a promissory note, and protected by a mortgage or deed of trust on the property. So, if the borrower doesn't perform, you have legal claim to the property, just like a bank would. You're not swinging hammers. You're not managing contractors. You're simply providing capital and earning interest. When most people think of private money lending, they're thinking of short-term, project-based loans. These are typically 6 to 12 months, tied to a specific project like a fix and flip, paid back when the property sells or refinances. The upsides of short-term lending is velocity. Your capital comes back relatively quickly and can be redeployed into the next deal. However, the downside is that once the loan pays off, you immediately have to find a new project, vet a new deal, potentially vet a new operator, and redeploy your capital again. That's where longer-term private money loans come in. Longer-term loans might be 18 months, 24 months, or structured as longer-term interest-only debt. The benefit here is consistency. Your money stays deployed, continues earning interest, and you're not constantly scrambling to place capital just to keep it working. Neither option is better or worse, they just serve different goals. Short-term loans prioritize flexibility and faster capital turnover. Longer-term loans prioritize stability and fewer decisions. So let's talk about the benefits of private money lending and why so many high-income earners are drawn to this strategy. The first, passive income. Once the loan is funded, your role is minimal. You're not managing tenants or renovations, you're collecting interest. 2, predictable returns. Most private loans have a fixed interest rate and a defined loan term, so you know what you're earning and for how long. 3, asset-based protection. Your capital is secured by real estate and supported by legal documentation, not just trust. 4, lifestyle friendly. This strategy works extremely well if you have a demanding job, travel often, or simply don't want another active business. However, no investment is without trade-offs. Some of the downsides of private money lending are 1, that your capital is tied up. Your money is committed for the duration of the loan, especially with longer-term deals. 2, operator risk. Returns depend on the borrower's experience, execution, and vetting really matters. 3, limited upside compared to equity. You're earning interest, not appreciation. It's more predictable, but there is a capped upside. So let me make this tangible with a real deal I funded recently on Oak Branch Way in Atlanta. The private money loan was funded in May of 2025 and paid off in December of 2025. During the entire time, I earned interest every single month. The loan was secured by a property itself, and at the end of the term, I received all my original capital back. Now, like many real estate projects, this deal did go a little bit past the original timeline, and that's important to acknowledge because delays happen in real estate. What mattered to me wasn't that it went slightly long, but that the communication throughout the process was excellent. I always knew what was happening, and expectations were clearly managed the entire way. That's a huge part of evaluating who you lend to, not just the numbers, but how they communicate when things don't go perfectly. And the end result? The before and after photos are absolutely stunning. The deal was a great example of how private money lending can deliver a consistent monthly income, asset-backed protection, and a clean return of capital without managing the project itself. I love real estate, but I'm intentional about how I invest. Private money lending allows me to stay involved in real estate, protect my time and flexibility, avoid operational stress, and still generate consistent asset-backed returns. Whether the loan is short-term or longer-term, Alignment with your lifestyle is what matters most, at least to me. If you're a high-income W-2 professional who wants real estate exposure without being a landlord, predictable asset-backed returns, and options for both short-term and longer-term investments, private money lending may be worth exploring. If this was helpful, like and subscribe, and comment below if you want me to break down how I vet borrowers, how to structure longer-term private money loans, or how to use retirement funds to invest in real estate. I'll see you in the next one.